Hello everyone, thanks for checking out my video. What a roller coaster week we had. Last Monday, S&P 500 clocked its worst day since 2022 in a global stock market sell-off. Then on Thursday, the index posted the biggest single day gain since 2022. By the end of the week, the US stock market has clawed back almost all of the week's losses. What an incredible comeback. What a wild and volatile week. With the turnaround, some are wondering if this is a dead cat bounce. Basically, can we trust this rebound? Let's discuss this in this video. As usual, do stay throughout the video to find out more. Alright, last week marked the most volatile week of 2024 for the US stock market. On Monday, Dow Jones plummeted 1,000 points, while the S&P 500 dropped 3% for its worst day since 2022. At the Monday lows, the S&P 500 was down nearly 10% from its recent all-time high. That's almost entering the correction territory. At one point, the VIX index, which measures the volatility and fear in the market, spiked to 65, a level that we have not seen since 2020's COVID pandemic and the 07-08 global financial crisis. The sudden sell-off can be attributed to a very weak US jobs report from the prior week and concerns that the Federal Reserve was too late with rate cuts, along with the unwinding of yen-carried trades by major hedge funds. But the major indexes mounted a remarkable comeback as Thursday's encouraging weekly jobless claims number helped to alleviate investors' concerns about a recession. On that day, the S&P 500 and Nasdaq both rallied over 2%, with the former posting its best day since late 2022. By the end of the week, the major indexes were near where they started before the global sell-off. Well, a week of panic has come to a close, but I don't think the crazy volatility has ended. Looking at the week ahead, Wall Street will have plenty of economic data to unpack, which again can swing the market wildly. The biggest headline for the week would be the CPI data that is set to be published on Wednesday, 14 August. This fresh data point could be pivotal, as favorable report would offer the Fed confidence to start the easing cycle. In other words, to cut rates. In fact, the market widely anticipates a rate cut during September's FOMC meeting. The only question is how substantial it will be. Okay, prior to the release of CPI, the market will get to see the PPI data first. In case you don't know, PPI, also known as Producer Price Index, measures the change in prices that manufacturers pay to suppliers. Basically, it provides a gauge of prices that producers can get for their goods and services. But of course, economies and investors tend to put more weight on the consumer-focused inflation readings, which is the CPI. Then on Thursday, we will have another round of jobless claims, which will again carry some significance, like what we saw last week, where the market cheered after jobless claims fell more than expected. This is because after last Monday's brutal sell-off, the market is looking for reassurances of a resilient economy and labor market. In terms of the earnings front, major retailers Walmart and Home Depot are scheduled to report their quarterly earnings. Some other notable names and retail favorites that are also reporting this week include Sea Limited, Alibaba, Grab and Cisco. Alright, let's move on to the technical analysis segment. Well, I am bringing back SPY based on viewers' requests. But just to share, I have to condense certain sections or technical analysis because as the length of the video gets longer, the time needed to prepare gets longer too. Okay, SPY, which represents the broader market, looks slightly bullish at the moment. As you can see, it has created higher lows last week. Whether this bullish momentum can continue into this week, it depends on one important level, and that is the 61.8 Fibonacci level at around 535. Watch this level very closely this week. If SPY reclaims it, fill that gap between 536 to 539 and don't get rejected, then it is a positive sign. The next resistance lies at 541 to 542 area, where the next Fibonacci level and the 50 moving average are. Or perhaps I will stretch it to 544 as I drew a new Fibonacci retracement level. You can see that 544 is where the 61.8 Fibonacci level is. Therefore, if SPY can go above 544, it is very bullish, and I would expect it to go even higher towards the 450s range. In short, on the upside, watch for 535 and 541 to 544 area. As for the downside, it's basically the opposite of the upside. If SPY gets rejected by those resistance levels that I mentioned earlier, then it's bearish. The longer SPY stays below 535, the more bearish it is. To add on, pay close attention to 516 as that is the full 100% Fibonacci retracement level from the recent high. SPY almost broke below that during last Monday's sell-off, but it managed to recover by the end of the day. If that breaks, I would think there is a high chance that we head towards the gap between 504 to 506. When that happens, that means we will see another sell-off in the broader market. Let's now jump over to Apple. Apple's chart looks a little similar to SPY. First of all, it has also created a series of higher lows. That's positive. On top of that, it has broken above the blue downtrend line. That's even more positive. Similar to SPY, watch that 61.8 Fibonacci level closely this week. The bulls will try to bring Apple above this level at around 218. This level is also where that tiny gap sits, so watch for any rejection. If Apple gets rejected here, don't panic yet. It could do a classic retrace and retest where it may head towards that blue downtrend line. That's when the bulls will want to see a bounce off that trend line. If it happens, it means Apple's bullish momentum is continuing. But of course, if there is no retracement and if Apple immediately reclaims that 61.8 Fibonacci level, that's even more bullish. That's when I think we could stand a chance to move towards 222 to 225 area. Okay, on the other hand, if Apple retraces this week and doesn't bounce off that blue trend line, that will bring Apple below 200. Just to share, 200 is quite important because it is a strong psychological support level and it is also where the previous high was. Therefore, the bulls will want to hold this level because once this breaks, we could go as low as 195, at least in my opinion. In case you don't know, a 5-point drop from 200 to 195 is quite significant for Apple because that's equivalent to about $75 billion of market cap. Moving over to Tesla. Tesla is trying to recover, but the strength isn't there yet. As you can see, it is still below this short-term blue downtrend line. In terms of the upside, there are a few levels to watch this week. These levels are the 200 moving average at 203, the gap between 203 and 205, the 61.8 Fibonacci level at 207, and the 50 moving average at 210. Unlike Apple, Tesla can move easily 10 to 15 points in a single day. Therefore, I would lump all these resistance levels together, which forms the area between 203 and 210. From the chart, you can see that Tesla attempted to close that gap and to break above 200 moving average for the last 4 days. And I would expect Tesla to test this area again this week. If Tesla can go above the area that I mentioned between 203 and 210, it is quite bullish because that will bring Tesla above the blue downtrend line. From there, maybe we may face some resistance at 220 because this is where the next Fibonacci level is, as well as where the purple long-term downtrend line sits. Well, if you are able to ride the wave up from 200 to 220, it would be wise to take some profits and then observe if we get a rejection at 220. If Tesla goes above that, we could fly, at least towards the gap between 234 to 245. Alright fellow viewers, if you have found some value in my weekly market analysis videos, do help me like this video and perhaps comment something below. That will help to grow this channel. I really hope to reach a wider audience and hopefully it can benefit more people. And if it's within your financial means, feel free to buy me a super thanks or treat me to a cup of coffee via my Ko-Fi link. Okay, in terms of the downside for Tesla, can you see this small little consolidation area? It's between 160s and 180s range. During last Monday's sell-off, Tesla almost fell into that zone, but fortunately, it managed to recover. So watch this area closely this week. If somehow there is a sell-off again and Tesla started to close at the 180s range, I think it will open the door towards the 160s range. At the 160s range, pay very special attention to 167. This is a level that Tesla has bounced off twice previously. If it gets breached, can you see that gap there? Tesla could head towards it. Let's now check out Google's chart. Google has fallen off the cliff since it hit an all-time high of 191. But just like many other stocks, it has recovered a little bit last week with a series of higher lows. But for Google, it has to do a lot more than the earlier few stocks that I covered because it is still some way off the 61.8 Fibonacci level at 174. But the positive thing about Google is that it has managed to reclaim the 100% Fibonacci retracement level at around 162 before the end of last week. It is also noteworthy that it actually filled the previous gap up and bounced off the gap. That's a bullish sign actually. From here, so long as 162 holds, or if we print two green candles with decent volume, I would say there is a high probability that Google will touch 173 at least. Above 173, resistance can be expected at around 177 where the 50 moving average and the next Fibonacci level are. But if Google can climb to this level these 2 weeks, I wouldn't be surprised that the bulls may even bring it up to 180 to close the gap. But to reach this level, Google does have a mountain to climb. On the downside, just like what I have mentioned, watch that 162 like a hawk. If that breaks, we could test 155 again, like how it did last week. And below 155, the last line of defense is the 200 moving average at 153. This is one area that I will consider stepping in. In fact, when Google was at 155, I almost wanted to step in, but I waited and missed the opportunity. Okay, let's now jump over to Meta. Meta looks interesting. Remember I talked about this bullish inverse head and shoulder pattern? It's playing out quite nicely as last Monday's sell-off saw Meta bounce off the right shoulder. From last Monday's low to Friday's closing price, Meta has gained close to a whopping 15%. Alright, before the bulls get all too excited, if you could recall, I also mentioned about the neckline at around 521. And right now, Meta is heading towards it, trying to test it for the second time. But because this is a real life chart and not a textbook version, so the neckline is not so well defined. Meaning to say, we can't even stretch the neckline till around 530, a high that was created back in April this year. In short, let's take one step at a time. If Meta can reclaim 521, that's pretty bullish. But if it can go above 530, wow, that's very bullish. And I would then expect Meta to probably even go near the recent all-time high at around 540 to 542. Actually, theoretically speaking, if Meta were to break out from the inverse head and shoulder pattern, it could potentially charge towards 600. I know that may sound a little crazy when the short-term trend for the market is a bit bearish, and I want to be a bit more conservative as well. So like I said, let's take one step at a time. In terms of the downside, those Fibonacci levels that you see on screen are all support levels, but I will only pay more attention to two of them, and they are 466 and 442. As you can see from the previous occasions, whenever this 466 level breaks, it's almost certain that we will see 450's range. As for 442, why it is important is because that's the right shoulder of the inverse head and shoulder pattern. If that breaks, then it will invalidate the bullish pattern. Moving over to Microsoft. Microsoft is on this pretty steep short-term downtrend, which offers investors who believe in the company to buy shares at discounted price. That was why I stepped in recently. From the chart, I think it's quite clear that 389 is a decent support as Microsoft has bounced off this level on 2 occasions, include last week's sell-off. This also means that if somehow this support level breaks in days or weeks to come, we can expect Microsoft to open more gateway to the downside, and we are talking about below 380. That is where the small consolidation zone is, between 365 and 380. This is actually an even better to pick up more shares. By the way, within this area, 365 is critical because apart from it being the important 161.8 Fibonacci level, it is also where the previous high is. Anyway, for Microsoft to drop 40 points from the current level, something really bad must happen in the market. In terms of the upside, it is good that Microsoft has reclaimed the 100% Fibonacci retracement level at around 405. From here, it has to remain above it. The longer it stays above 405, the higher chance that it will grind up towards the top end of this consolidation area at around 429. But of course, if we can get more solid green candles above 429, it will naturally opens up more upside potential. And I would say probably towards the gap area between 441 to 443. Finally, let's move over to Nvidia's chart. Similar to a few of the earlier stocks, Nvidia is on this short-term downtrend with two key things to watch. First, it's the blue downtrend line. Second, it's the 61.8 Fibonacci level. It's nice to see that Nvidia has successfully reclaimed that 61.8 Fibonacci level at 100. But that being said, we are not out of the woods yet. I mean, as you can see from the chart, the bulls and the bears have been battling at this level for the last 6 trading days. Therefore, come this week, watch this level closely again. If it breaks, then obviously it's bearish. And the longer it stays below 100, the higher chance that it will continue to drop towards the 80s and the 70s range. But just like Google, one positive sign is that Nvidia filled the gap up during last Monday's sell-off and managed to recover by the end of the day. For me to call Nvidia bullish, I would want to see it breaking above the blue downtrend line. If we can have about 2-3 green candles above it and stays above 108, then the MACD will likely have a bullish cross. Just to add, 108 is an important resistance level that Nvidia needs to go above because Nvidia has tested this level 3 times in the last 6 trading days. Also, this is where the Ichimoku cloud resistance is. If Nvidia can go above both the trend line and 108, I would say Nvidia is turning bullish. But for full-blown bullish movement, it needs to go up to fill that gap between 120 to 122 and not get rejected. When that happens, I would think FOMO buyers will step in and probably ride it up all the way to 130's range again. Okay, moving over to the options trading segment. Moving forward, I will be excluding my day trades and swing trades from this section. I will focus more on options real strategy, which has longer DTE or days to expiration around 30 to 45 days. Otherwise, the length of my videos will be very long as I have added Microsoft, Meta and Nvidia to the technical analysis segment over the last few months based on viewers' requests. As the video gets longer, it's taking me a lot of time to produce them. Just to share, on average, it takes about 12 hours to produce a 27 to 29 minutes video. As the weekend has only 48 hours, so 12 hours is actually a quarter of my weekend's time. And if you minus off my sleep hours, I don't have much time left for my weekends. So yep, I hope to have everyone's understanding on the change. With that, I only have one option trade to update this week, which is a cash secured put on Tesla. The contract was sold on 6 August with a strike price of 160 expiring 13 September. So on 6 August, the US stock market was rebounding off a global market sell-off that happened the day before. At that point, I was of the view that the massive sell-off, whether it was caused by the unwinding of yen carry trades or recession fears, it was a bit of an overreaction. But that said, to clarify, this doesn't mean that the market will not go lower from here, but if you have followed me long enough, you will know that after an overreaction, the market tends to stabilize a little bit, which means we could see a possible sideways movement or a small bounce. To add on the day of sell-off, Tesla's candlestick fell completely out of the Bollinger Band when the market opened. So again, I think we could go sideways in the near term as the candle will eventually move back into the Bollinger Band. So this was why I stepped in to sell a put, which is a slightly bullish move. And guess what? Tesla went sideways the next few days and the trade is currently sitting on a profit. Just to add, because of the huge sell-off in the global market, the implied volatility went up, which means options premiums became more expensive. As an option seller, that's to our advantage because we collect more premiums for our sell put and sell call trades. On a side note, even if Tesla plummets in the next few weeks, there is no need to panic. If you could recall, I had 200 shares of Tesla that got caught away recently at a strike price of 200 and 190. So if Tesla falls below my strike price of 160, it's not a concern. I mean, I can get back my Tesla shares at a lower price than the ones that got caught away. Isn't that good? Okay, some quick end thoughts to wrap up the video. Last week's volatility was nothing but crazy. We saw a $1 trillion sell-off on a single day, and then we had a $1 trillion gain on another day. Many investors might find it difficult to stomach such volatility. However, as of the time of recording, the stock market's volatility and fear gauge, also known as VIX, has fallen off the cliff and is currently sitting at around 20. This is a far cry from its intraday spike on Monday to 65, so this could give nervy investors a bit of breather right now. Okay, in my personal view, the fall in VIX makes a lot of sense, as the earlier brutal sell-off was likely caused by an overblown and exaggerated fear of a recession and the unwinding of yen carry trades. Moreover, whenever VIX spikes to a record high, it is usually followed by a significant drop. Last week's movement in VIX has once again confirmed this pattern. At this point, I don't see strong fundamental threats to the US economy yet, at least for the next couple of months, and I believe many investors had echoed this sentiment as they stepped in to buy the dip last week, including myself, as I dipped my toes in again for Microsoft during last Monday's sell-off. Later in the week, dovish words from the Fed officials and encouraging labor data had also given investors assurances that we are not near recessions for now, which helped to calm the panic mood. Okay, back to the questions that I posted at the start of the video. Is the latest rebound in the market a relief rally? Can we really trust this bounce? Well, I don't have a definite answer to this, but what I can say is things may not look very good at the moment, but they are not as bad as expected. So do stay calm amid the chaos. Be cautious, but not too fearful. Don't forget, there is another wildcard in the Middle East. If the region erupts into a broader conflict, it will be a completely different story. Market sentiment and my sentiment will definitely change. Alright, if you have found my weekly free content useful, do help me grow the channel by tapping on the like and subscribe buttons. Thank you very much.